All right, let's talk about NVIDIA. It's a company that's pretty much at the absolute center of the AI universe, right? But the big question is all that hype for real? Well, today we're going to find out. We're going to follow the money and do a deep dive into their financials.
So you see this all over the news, right? NVIDIA is one of the most valuable companies on the planet. But you have to ask yourself, what are the numbers really telling us? That's what we're here to do. We're going to peel back the layers, get past the headlines, and see if the stock's price actually matches what the company is fundamentally worth.
Okay, so here's our game plan. First, we'll get a quick snapshot of the company. Then, we'll check its financial vitals. After that, we're going to peek inside the books. Then comes the fun part. We'll calculate NVIDIA's intrinsic value. And finally, we'll compare that price to its value and reach our verdict.
All right, let's kick things off. Section 1, NVIDIA, the company snapshot. Let's get to know this titan of tech.
So on paper, NVIDIA is a semiconductor company. But you know what? That description barely scratches the surface. These guys are, and I mean this literally, at the very heart of the AI revolution. They design the GPUs, those critical graphics processing units, that are the engine for today's most advanced AI. We're talking everything from massive data centers to the tech in the car you might be driving in a few years. Okay, moving on to Section 2, checking the financial vitals. This is where we start to see the story of just incredible scale and growth unfold in the numbers. First up, the market cap. Get this, $4.39 trillion. Just let that sink in for a second. To put that into perspective, that's bigger than the entire economy of most countries on Earth. It's a staggering number, and it represents the total value of all their shares out there. This puts them in a very exclusive club of the world's most valuable companies. And then you see this number, 62.5% revenue growth year over year. I mean, come on, that's not just steady progress. That's not just good. That is an absolute explosion. It's a crystal clear sign of the insane global demand for their tech. Now, this table is where things get really interesting. You see the trailing PE ratio is about 44, but look at the forward PE. It drops to 24. What does that tell you? It tells you that analysts are expecting their earnings to grow like crazy. Then you've got a gross margin of over 70%. That's just phenomenal profitability. But the real showstopper here, for me, is the return on equity, over 107%. That is just stunningly efficient. It means for every dollar of shareholder money they have, they're generating more than $1 in profit. Incredible. Okay, on to Section 3, a look inside the books. To really get what's going on with NVIDIA, we've got to dig into the core financial documents. Right, so we're looking at what I call the 3 pillars of financial health. First, the income statement. Basically, is the business profitable? Second, the balance sheet. What does the company own and what does it owe? And third, the cash flow statement, which is all about how cash moves in and out of the company. Each one tells a totally different but absolutely crucial piece of the NVIDIA story. Whoa! Okay, just look at this income statement. The trend is, well, it's about as clear and dramatic as it gets. Look at the net income line. It goes from about $4.4 billion in 2023 to nearly $73 billion in 2025. That is not growth, my friends. That is a rocket ship, an absolute explosion. And the balance sheet tells a similar story. You see their assets and their equity growing substantially, right? But what's really impressive is that their debt has been managed really well. It's actually gone down a bit. This paints a picture of a company with a fortress-like financial position. All that massive profit they're making, it's just ballooning their equity, making them stronger and stronger. And now for the cash flow. This shows just how powerful their ability to generate cash from their main business is. And that cash is what funds all their investments and future growth. The number to watch here is free cash flow. That's the cash left over after they've paid for everything they need to run and grow the business. It has multiplied by more than 10 times in just 2 years. That's what you call a true cash-generating machine. All right, that brings us to Section 4, calculating NVIDIA's intrinsic value. So we've seen the numbers. They look fantastic, right? But the million-dollar question, or in this case, the trillion-dollar question, is what does that mean for the future? What is this company really worth? To answer that, we're going to use a method called discounted cash flow, or DCF for short. Here's a simple way to think about it. Imagine you're buying a fruit tree. You wouldn't pay based on how much fruit it grew last year, would you? No. You try to estimate all the fruit it's going to produce for the rest of its life, and then figure out what all that future fruit is worth to you today. That's exactly what DCF does. It helps us ignore the daily market hype and focus on the business's long-term ability to generate cold, hard cash. Now, of course, anytime you're trying to predict the future, you have to make some educated guesses or assumptions. For our DCF model, the key inputs are things like risk rates and, most importantly, growth estimates. So we've plugged in what we think are some pretty aggressive but still plausible numbers. We're talking a 40% growth rate for a few years, which then settles down to a more normal 12% long-term rate. These numbers are absolutely crucial for what comes next.
So, after running all those numbers through the model, we get three possible outcomes. We have a bear case, which is a more pessimistic view, a bull case, which is super optimistic, and our base case, which is what we think is most likely. And that base case suggests an intrinsic value of about $227 per share.
And this is it. The moment of truth. Section 5, price versus value, the verdict. We've calculated what we think the company is worth. So, how does that stack up against the price on the stock market right now? Okay, let's put it side by side. In one corner, we have our calculated intrinsic value from the model, $227. And in the other corner, we have the recent market price, about $180. It's pretty clear, right? The model suggests the company's fundamental value is significantly higher than its current price tag.
So, what's the bottom line? Based on this specific DCF analysis, the conclusion is pretty straightforward. The stock appears to be undervalued. Now, this is all based on our assumptions, of course, but it does suggest there could be some serious potential upside here if the company can keep hitting those amazing growth numbers.
But that leads me to one last question for you to think about. Our model says the stock is undervalued, and even our bull case puts the value at around $317. But with the future of AI looking so explosive, you have to wonder, is even our most optimistic case too low? And that, right there, is the biggest challenge when you're trying to value a company that's literally inventing the future.